Good evening, everyone. Welcome to another webinar. I'm glad to see many of you here tonight. Um, so, if you weren't aware, tonight is actually on trends, and it's not just the normal idea of looking at technical trends and consolidation of markets and things like that. I do cover that, but I'm also going to be having a look a little bit later on in the webinar about how we might look for value opportunities in trending themes of the general global markets. And that might be beyond just looking at financial markets. It could be something to do with the macro or the micro side as well. So to kick things off, as always, I do have to give a disclosure warning or a risk warning. And this is to say that financial markets can carry a high level of risk and that you should know your risk tolerances, what your trading experience is like, and that it is possible to lose more money than your initial investment. So be careful with your trading. Now, if you do need any advice or anything like that on that sort of side of things, then I'm sure any one of the people at ACY will be happy to give you a hand with that. But for the purpose of this webinar, it is entirely educational. Now, it may seem obvious, and I am going to be switching back and forth a little bit tonight between the looking at the charts and also some different variety places of where you can get information and news from, and as well these slides that I've got sort of coming up. But to most, it might seem obvious that a trader has to understand what direction the market is moving in and then sort of try and take advantage of that prediction. Usually we can categorize it into sort of three different things. It's either trending up, it's trending down, or it's trading sideways, or what we consider consolidation. Like everything in trading, when we reduce it down to a list, it seems pretty straightforward, but the reality is not always so clear. And it's really the trader's job to interpret what they are observing and to form an opinion about the future. Many traders will have their own definition of trend, and I'm going to try and describe a few different methods that you might use to define or describe a trend tonight without looking at the most obvious things that you can. So the first one, and this is where we will start switching around. I'll give you a bit of the front end of it first and what we're looking at, and then we'll move on from there. So in the first approach, we're looking at the idea of using just a single moving average. It's really easy to do. If you're new to trading, this is something that you can implement if you're still picking up some of those other skills. It's a really simple approach, and it basically says if price is above the moving average, the market is in an uptrend and should be traded for buy trades only. And so this is a way that you can actually put a little bit of bias in your direction that you're trading in, and it helps take out some of the other noise that you might have. When you're new to the trading, this is sort of an important theory. On the counter side of this, it's if price is below the moving average, obviously, the market is going to be in a downtrend and we should only be looking for sell trades. So an advantage of using this sort of method is that it is quite simple to use. I'm just going to switch my screen across to a chart so that we can have a look at that as well. And I've got some charts that I've already set up today that will give you a bit of an idea on what I'm talking about. So the first one we're going to have a look at here is what I was just saying. We were just talking about a single moving average and how we might consider using it. So in this instance here, where we're looking at price as it is natively on the chart, right now where price is, it's sort of right smack bang in the middle. It could be what you would consider to be called consolidated. So we would be looking at this as an idea of perhaps price is changing direction, or perhaps it's having a little bit of a rest and we're waiting for it to see what it does next. But in the earlier piece where we're looking at sort of this area here, we can see that it's obviously in an uptrend. We've got price mostly staying above this line and continuing to trade its way up and above. I'll just take that off so it doesn't flick around. And we could then consider the idea. Now, we've obviously had a run down here. It's swapped over, and this is this area of a little bit of consolidation that's occurring. You could even call this whole period to be some level of consolidation because price isn't quite 100% over that line and hanging out up there. And so when we would then come down is we would start to consider, we'd go, okay, well, when price comes down here, then if price was above, you might have considered taking a long position here. And then you would have been faked out and would have resulted in a loss. But then after that point, each time that price does come back up and it does start to get into that sort of trending phase from here on, you actually do make some solid gains. In this instance, 330 pip. And then you can keep on counting that measure up. Again, you'd be about 230. This sort of method does take a little bit of practice, and it goes really, really well with using your pattern recognition and candlestick analysis skills. It allows you to sort of take, like I said before, a little bit of that noise out when we're thinking about it. But really, the real advantage of it all is that it is simple. So to give you guys a bit of an understanding on what I've used on this indicator here, it's a 50 exponential moving average. And it really just shows that trend is initially rising with price above an EMA line, and then it will shift on the downtrend side when it crosses below. There are two areas where trend can be ambivalent because price temporarily crosses that EMA and it does sit down. You're not quite sure where it's happening. Usually it is at places like this and places like this. It is that area in between, the transition between one trend and another. It does become a little bit more less clear cut when you change the settings on a moving average as well. So if you were to use some of the common ones, which would be a 50 period or perhaps even a slower one being a 200, and then the faster ones would be obviously below the 50 side of things, you tend to find that it'll give you some different information. So a slow MA will monitor the trend on a longer term basis, while a faster MA monitors trend on a shorter term basis. And you tend to find that on the shorter side of things, it'll capture rapid changes in direction a lot better. So in this next chart, I'm going to show you here to give you an idea. This is just, we're going to move into a couple of different ones. But this next chart, no, not that one. It is this one. This chart here, I have effectively a 50 moving average. It's a 48. And then I've got two 5 moving averages. And they've got some slightly different settings. If you've seen some of the other webinars, you may have even seen this. This is one that I usually teach some of my students to help them with their candlestick reading. And what goes on here is that we can see that the 5 moving averages are sitting very close and tight to price. And they do give you a pretty good idea on where you might consider getting into a position. And if you had have been able to be sitting at the computer at the right time in the last couple of hours or days, you would have been able to get in for this sort of uptrend that's sort of been going on now. And the way that we would have looked at this would have gone, okay, well, price, we keep the longer time frame moving average, the 50, as our bias or our directional scale side of things. So we'd go, okay, well, we think that because price is above that 50 MA, we can say we're probably in an uptrend. We would then use the smaller moving averages, the 2 5s, to consider when we might get into an entry. We know we're going to have a bias of probably going long. And then each time as it goes up, we would go, okay, well, here we've got a crossover of these prices are almost occurring. It's probably not an optimal point to be getting into a long position right here. And then this section here would break out a little bit and you'd have the same sort of thought patterns because you'd go, okay, well, we've had this really big candle. Don't forget, it's all a lagging indicator. We need some more information to see whether it's worthy getting in. And you would likely probably try and get in there if you were new to it. And you would hold on and you'd be staying in until you got a crossover of this red signal and you would exit. At this point in time, you're probably out of pocket a little bit here. But the next round that comes up, you don't go in, you got price come down, you probably missed this one as well because you've gone in short. But then when it comes back up here again, you kind of make up for those 2 first losses because you then get the run of the full scale of the trend. And in this case, it would be quite supportive of your account right about now. So there are a number of different ways to do it. You can sort of hold in for the long going of the trend, or you could even choose to get out at this point here and then get in again at this point here. So you'd end up getting in on this candle that I've got the crosshair over now. And then you'd keep rolling it up and rising it up. And so the same thing happens on the other side of it. Now, another way of thinking about trend is what we call using a dual moving average sort of system. So I'm just going to talk you through it before we go through the chart on it. Now, the dual moving averages, the approach is very similar to using the single moving average, but it adds the requirement that both moving averages must be in agreement to define your trend. So it puts a little bit of a filter in there for you. It helps you try and stay out of that consolidation side of things. And if the two trade, they're not both in agreement, then you can sort of say that the trend is uncertain. So using 2 tries to help filter out those consolidated parts that would usually fake you out in using a single moving average. Most traders, when you sort of do get into the middle ground, would consider that to be like a no trade zone. So the rules of it, or the approach of it, is pretty simple. If price is above the slower moving average and the faster moving average, the market is likely in an uptrend and buy trades could be considered. If price is below the slower moving average and the faster moving average, then the market is in a downtrend and sell trades are to be considered. If price is in between the two moving averages, and I'll show you what that means in just a moment, then the trend is what you would consider to be uncertain. So let's just have a quick look here on what I'm talking about. So right here on this chart, I've got two moving averages. We have a 50 moving average and we have a faster one being a 13. The reality of the time frames, or sorry, the periods that you've got for the moving averages really doesn't matter. If you've got as long as you've got one that's faster than the other and there's a little bit of difference between what they are, then it will make it a little bit easier. So I'm just going to flick this off so we can have a look, and I want to show you the first piece being that if price is in between the two, then we would consider not taking trades. So this area is where I'm sort of talking about. Price is really consolidated. It's not really getting much growth. It's pretty flat. There's not much real action happening. It's pretty choppy, if you would say. And we can see numerous times throughout all of this that price goes in between this line here and the blue and the red, and again in between my mouse playing up, the blue and the red here again. And this keeps occurring all the way through this sort of range and period. So this is an area that you would go, okay, well, I'm going to say this might not be the best time to consider looking for a trade. And we're going to wait until we see somewhere that does actually have some stuff that we might like. So right now, the next piece to sort of consider for is here. The only thing that makes this area unattractive for that sort of thing is this big candle, which you can probably already see, but I'll just highlight it just in case, is this period here. Because it has such a quick jump up in price, the moving averages sort of take note of that, and then they accumulate that into their data and try and average it out. That's what a moving average does. But once it gets past this period, it probably gives you not a bad opportunity to consider it. Yes, we have price come back into this area, so we'd go, okay, this is probably an area I'm not going to consider a trade. But once it's on the other side of this, we would certainly think about it. And if we saw something obvious that might go when we get to these sort of bars, these little candles here that I've got my cursor hovering around now, we can see that we've got a couple of engulfing candles and occurring in a row. And eventually we've got the one with the bigger wick, which indicates that price is likely to go up further. And then we've got this solid one that closes well and truly above the previous red bars. So here is where you would consider looking for your position. You'd likely end up in on this big one. If you got in quickly, you might have been able to avoid getting out at the top, but regardless, it stays in. And if we were to follow this position up for a while, you would end up making a few pip. And then if you were able to ride out this area of no trade and just hold onto your position, you could keep going. Now, one of the ways that you can consider using this with a sort of a stop loss or a take profit, and again, like I said, it doesn't really matter what time frame you're using, doesn't matter what sort of period you're using, as long as they're slightly different, you've got one faster and one slower, then the idea could be quite simple. If you were to, you could use it as a very basic trading strategy to help build some of those other skills you've got. And you could say that if price is above the blue and the red, then I'm going to look for my long entries. Then you've got to think about where you might exit your positions. The faster way, or the way that would get you chopped in and out, and this might be for those of you here tonight who might like to do a bit of scalping or some of that sort of short interim time frame on much tighter trading times, then you'd be able to consider the idea of each time it crosses this red line back down into price, then you would exit your position. But if you are one of the guys that likes to get into the trend and hang on to it for quite some time, then you might consider getting in and then using the blue line. And when price crosses the blue or the slow moving average, that would be your point of exit. So the moving averages and the trends can't always be defined, but this sort of does give us a way of sort of working it out and looking at where we might find some consolidation. It may be transitioning between an uptrend and a downtrend or vice versa, or it can just be fluctuation. But either way, using two helps take out a little bit of that noise. Now, the next one for us to have a look at tonight is on using three multiple moving averages, and you would try and use a little bit of a pattern in them if you can. Now, in this approach, it does use multiple moving averages and the way they move with each other to try and define the trend. So you're not looking at price so much, but of course, you're still going to be wanting to use some of that candlestick analysis and that pattern recognition, and if you are on more the technical side of things. So When the lines are meandering back and forth and over each other, this is an area that we can go that price is disorganized, it's probably consolidated, and it doesn't really have much direction in it and certainly no trend. When the lines are actually in order and the slowest line is above the fastest line, then the trend is down. If it's the opposite, the trend is up and price is accelerating. If the trend is down and the distance between the lines is reducing, then we can have a look at that and consider the idea that the trend is actually contracting or it's slowing itself down. There's a few of these different rules here that you can read. Feel free to screenshot it if you like, but I'd much rather show you what I'm talking about because it's quite hard to distinguish some of the words that I might be talking about and versus actually looking at it on a chart. So this is what I'm talking about here. I'm talking about having numerous moving averages. And in this case here, the moving average that I'm using, you might call it a fan, you might call it a rainbow, you might call it something else, but you do quite often see this around when people are sort of thinking about a direction, but they're not entirely sure. When it comes to my own moving averages here, I tend to use Fibonacci numbers because I feel that if there is any luck in Fibonacci, then I would like to have it and it doesn't really do too much damage. So I'll use a 233. I'll then move my way down to 144. Then it ends up being a 90 something and an 89. Then we move down again and we end up at 55. And we get to the 30 sort of range, 34. And then the last one is usually a 21. Below that, you would go a 13. Then you'd get to a 9, then you'd have a 5, then you'd have obviously get right down to a 3 and then a 1. So what are we actually looking for in this sort of an instance? Well, the first place that I was talking about is when we have the trend in the lines in order and the fastest line is above the slowest line and we're thinking about the trend being up, then this is the area we're looking at. You can see here we've got our fastest line at the top, our slowest line at the bottom, and it is giving a bit of an idea on where price might go next. Naturally, it's all a bit higgledy-piggledy at the moment because markets have been quite turbulent, but we can still go back and find some decent sort of places to sort of have these sort of considerations in place. If you do have them expanding and fanning away from one another, then that is where you're sort of seeing that trend accelerate. And that sort of makes sense because we've got, this big move running up and it sort of all fits together. Now, if I zoom this out a little bit and we have a look here, then a good opportunity for sort of looking for positions could have been in the last couple of weeks. This is a 15-minute chart that we're looking at. It could have even been in the last week. And we've got this big downtrend occurring. And we can see that pretty much the whole way through this, we have the 233 moving average on the top. And we have our fastest moving average, the 21, on the bottom. So this is showing naturally what we just went through the criteria before. This indicates that we are in a downtrend and that we are likely going to be able to be looking for short positions. So how will we go about considering that? If we've established that we've got sort of price in that sort of range, then this area here would indicate that with the fanning of these moving averages, that price is accelerating. When we see it come back up over here, we can see that the trend is deaccelerating or it is contracting and it's having a little bit of a rest. So the opportunity really lies in how we determine what we look for in these moving averages. And when they're expanding, we want to be looking for a position. When they're contracting, we want to be either considering and looking more at the price and what's going on with price action itself, the candles, the bars, everything else you might want to look at to see where we might consider getting in or out of a position. In this instance here, we've got a little bit of a double top formation sort of occurring. It's not quite perfect, but it's not far off. And from there, you would sort of go, okay, well, perhaps this is another place we might think about it. When price gets past all our moving averages and starts to move down again, we still aren't quite ready because we haven't seen our 21 hit the bottom side. And it's not until sort of here that we do get that sort of happening. And at this point, we would consider another position. And you could keep on rolling this down as far as you wanted to go. And just like the double moving average or some of the other ways of trading with moving averages I've shown you tonight, you can consider the idea of getting out either when you get a cross of price over the big lines like you get here and then you get here, or you could simply use it to try and cross the smaller ones to keep you in and out to try and trade some of that chop. So this is another way that you can sort of approach how you might consider looking at it. Usually you'll find that these sort of moving averages you want to use with a simple moving average. An exponential is fine as well. If you're using some other types of strategies, we might use a linear weighted, but for the majority of these ones I've shown you so far, and they are strategies, but they're ones that you can own yourself. They're ones that you can work out and have a look and have a fiddle, find the lines that work for you and find the time frames that work. Regardless of what it is, SMA, EMA, linear weighted doesn't really matter too much. The linear weighted does have the most difference compared to the others when you look at it on the chart next to each other. Now, even though we've got that, there isn't a couple of other ways that I wanted to show you tonight. And yes, we're focused quite heavily on the idea of these moving averages. Now, the next one, I haven't got the indicator installed on my work computer, unfortunately. I am trying to see if I can find an alternative for it, but it will end up, whenever that app happens, then I will certainly make a update on that for you. Now, the next one to sort of have a look at here is called using an ATR stop. You can probably find these quite easily. I have my own ones that I really like, that I've sort of modified a little bit from eons ago, and I tend not to use them all that much anymore, but they are still quite handy to have. A stop indicator, I've discussed them in a couple of other of the webinars before, but in the context that I'm talking about them tonight, they can define the current market trend, and like a simple moving average, they can, you can use them as stop indicators as well, or where you might consider getting out. So, but they do have that really simple approach of identifying a trend. So, unlike the single moving averages, though, it doesn't generally, very much like the single moving average sort of approaches, it doesn't really help you identify consolidation all that well. And that is quite evident in this image that I've got here for you. Sometimes you'll end up getting into periods of price where you get a swap over between the red ATR and a green ATR, and price will meander around, and there might be a bit of time delay in between that actually happening. So the first things that we have to sort of consider when we look at these sort of things is obviously make an observation as to where the green side is versus where the red side is, and what we might look in that. An ATR stop generally shows your trend as the direction that it's heading in, and the way that we might use them as a stop as well. I mean, it is just in the name ATR stop, it is an indicator capable of identifying places, or at least helping you trail up a stop loss. But the adverse side of that is that you can move it in a different place, and you can use it to try and help identify with a trend. There's not a great, they're not real good at identifying range bound or consolidated markets. So if you are going to use the ATR stops, keep that in mind, especially if you're using them to identify for trend. In my past, I tended to use them for a stop loss purpose only, but nonetheless, the other adaptations of it are quite useful. Now, the next one, I will be flicking it back to the chart again, but we're just going to go through the idea of it first. So this one here is really obviously about trend lines and how we can use trend lines to sort of consider what might actually be happening in price. They're quite versatile. You can use them in various different ways, including defining trends and consolidation. You can use them to either, pick a downtrend. Obviously, when it's occurring, you tend to draw the line from the top. If it's going in an uptrend, you draw the line from the bottom. And if it's consolidation, you can usually fit a line on the top and bottom side, and they tend to be horizontal. So to sort of have a bit of a think about what we're doing there, I am just going to bring the chart back up again and show you a couple of different ways we can consider using those sort of movements. Now, I'm just going to get rid of this for you, so it's just blank again. We'll zoom it in a little bit, and we might move down to a 15-minute chart just so we can have a bit of a tighter look at price. Now, the first things that we can really sort of think when we think about the trend lines, if you've been to the Tuesday night lessons, you'll quite often see that I will put them on a much larger time frame like this, and I'll end up drawing a trend line there just to give a general direction. Now, that is the general idea of what you can do from the big point or the easy point. Moving it right down, though, to say a 5-minute position or a 5-minute chart, you can use it to identify minor trends. So in this instance here, we can see that there's a trend, that went off the screen. You can see there that we've got a little bit of a trend. You can't define with a trend line until you've got at least 2 points of contact. So they would be the second one, that'd be the first. You wouldn't have been able to draw this until quite late. But the next step that you can do is actually move this across so that you can then double it up and find somewhere else that it might fit quite well. So there's not too bad. Yes, we have a bit of a blowout, but it's a trend line. It's just a line, much like a moving average. When you do have situations like this, where you do have what you would call a range, and in this case, the range would have been about 10 pip, we can trade them up and down. So you can start, if you were able to sort of get in at some point a bit earlier, then you might have considered sort of taking longs from the bottom and trading them across, and then shorts from the top. Whenever you're on the downside though, I never try and go for the long moves. If you've got a trend that has quite a severe or advanced sideways action, or sorry, advanced trend, so in this case we've got a severe angle on it, and if we were to do in the current scenario of being up like this, or perhaps even a little bit tighter up that way, wherever you wanted to put it, you would end up getting faked out a fair bit. And when you go for on the upside thing, if you were to start going short, you would actually lose until you picked up the buy. So if you do have those angles where you've got sort of 45 from horizontal, then it's not a bad idea to consider just taking those long positions on the way up and trying to capture the bottom side up and not trying to get the counter trend sort of stuff. So that is a nice sort of way. You can obviously pair this sort of stuff up, but there are other little things that you can do as well. Now, I'm just going to clear this chart and give you another idea of how you might think about looking for positions and finding places to get out of them. So if we start, instead of thinking about this as one big trend, we can think of little ones as minor trends. And occasionally you can actually draw something like this, and it will be on a much larger time frame. And then you can do some little minor trends in between, bouncing between. And so what I mean by that is that, we've got a little bit of a run up here that's occurred. Then we could put put a trend line like this. And we might say, okay, well, while price is running up here, every time it comes back down, touches this trend line, I'll look for a long position if it presents itself. And if you were to enter that position and then it crossed this trend line, you would close that position. Then you could then move it to be a new trend line as another minor trend. So you might move it sort of in that way. And you would go, okay, well, I'm going to take a short off this point here because that's where I can easily do it. Take the short, and you would be aiming to get it back down this way. Now, if you were a scalper or using these short time frames, then you would ideally be looking at your candlestick analysis as well and your pattern recognition to try and be hot on the minute and trying to get in and out of positions as you see them. And if it didn't fall out or you did get into a good run, then you would once price comes back over your trend line again, you would close a position. And there are indicators that you can get that will enable you to do it. At least I know I've certainly seen some custom made ones. And so in this instance here in price, where in the last, sort of couple of hours, you might have seen that this has occurred. You might have gone, okay, well, you may have even just put this line on here. And then price has gone up. You've gone, oh, that's probably too hard and fast for me to have gotten into. But you then take a long off this one and you hold on to it. And then once it comes back down, it crosses price here and you close your position. And now you would start looking for another trade. And so the one that we might be looking for right now will be something like that. And we'd be waiting to see if price is capable of going up again or if it is going to fall down. Somewhere near this line, I would be looking for right now, considering it's in an uptrend, I'd be looking for an opportunity to take a long. So perhaps instead of considering where we might be going with price immediately, we might wait until price crosses this line because it is in an uptrend and we do have a counter trend sort of trend line occurring. We're waiting for the price to break this area to look for another trade up and then keep on moving our way along. So that is another way you can sort of consider the idea of looking at your price action and looking at your trading using trend lines. Naturally, you've also got the other methods where if you can find a place to put a horizontal trend line, you could just trail your stops up if you got in at the start and just keep moving it along as you go. There are some indicators available for download that you are quite easily able to do that. Now, the next ways that I'm going to have a bit of a talk about tonight, we're stepping away from the charts now, and I have a few different ways of thinking about this, and this is more to sit in with the people that might be a little bit more on the fundamental analytic side of things than the technical side of things. So technicals are all nice, but there are also the fundamental side of things and where we might consider looking for positions and where we might consider looking for news and information and where we can identify trends that are occurring in a macro environment. So the first places to start having a think about this sort of thing actually comes from the internet, but we would be finding a variety of different things. So one of the things I always like to do every single year is have a look for the macro global trends and what the outlook is for consumer spending, for marketing, for technology, a variety of different things we might be able to find. And usually when we go through these sort of reports, we tend to be able to find certain areas that might interest us. And this is a very important aspect because we always have these different assumptions that we have to consider. And you might start with places where the industry that you currently work in. So let's say you were in IT or something, or gaming perhaps, and you knew that an upcoming game is coming in. You knew that during the COVID-19 sort of era that we had some really good games coming out and lots of people were playing them and all that sort of thing. And you might be able to find that company publicly listed, and you would then go, okay, well, I know this sort of stuff is happening in advance, so let's buy a stock in it, or look at it from a CFD perspective and look in the DMA side of things. So that is one way that we can sort of think about it. So the first thing that I always go through in these sort of things, this is the most recent report I could find. Obviously, they tend to do these on a yearly basis. With COVID-19, some of them have been updated. As you can see here, COVID-19 is one of the change showing that there's going to be changes to the global economy. So the first thing that you tend to look at and find in some of these reports is that you will look at what's going on in the from the economic side of things, and they'll give you an idea of where we're seeing retail sales, jobless claims, what the most outstanding things are. They'll give you an idea of having a look at what it might look like in recession terms, GDP figures, and a variety of other things. They'll give you this general overview. So some of them will be more economically inclined, but you will get other ones that go along and fit more on the consumer spending side of things, which is where we really look to see where we might actually be able to get some good funding. The other part of that is as well is also looking at where businesses might be considering investing in. So if you know of a company who releases an annual report or gives you an idea of what's going on, or perhaps it's an industry and there's a whole heap of them. So the big one at the moment is this whole idea of environment, social, and global. So it's this ESG sort of thinking way of things, and they call it ESG. It's got its own sort of title, and it's really all about making the environments that people are working in either a green sort of environment, and that the companies are looking for places that they might be having a low impact on the environment. Then the social side is improving the working conditions for people, and that they're trying to work towards social change and all sorts of different things. So there's a variety of places that you can actually look. ESG is just one of them. Now in this, it's showing what the general trends are. We've got a low drop in oil prices occurring. We've also got a low demand occurring. We're likely to see that they're saying that their expectations are that China's economy is going to recover be faster than what some of the others, but Canada will probably last longer. And it'll be a little bit of different things all through it. And sometimes it's interesting, sometimes it's not. You tend to go and pick through the stuff that you find interesting or catches your eye. Because if it is going to catch your eye, then it means you might stay up to date with it. If it's something that you're not going to be real interested in, then it doesn't matter too much. Some of them can be nice and short, like this one here. It doesn't have too much in it. It's nice and easy to read. It really is all about the economic impact that's going on right about now. The next one that we can have a look at, and Deloitte are one of the ones that I actually like looking at. Deloitte make this series called the Deloitte Insights. And you can get a few of them. So I've got another one here. We've got another one just here when it decides to load. That's embarrassing. That you can go through on the web pages, and then there's another one just here, another Deloitte Insights thing. I was going to show that web page last. So, we can have a look at what they do. So this one here is the global marketing trends, and we might go through and go, okay, well, what are they looking at doing and things? And just even in the contents, you can have a look and see that they're talking about the purpose of things, what people are doing with paying down their debt, the fusions of businesses blending and trying to put businesses together, and a variety of other things on leadership and finding out the most valuable things. And so these reports are quite big usually, and they will cover everything in a certain place. So here they're saying that with the purposes everything part is about you can see here companies that lead with a purpose and build around it to achieve a continued loyalty, consistency, and relevance in the lives of their consumers. So that is basically saying that if the consumers see that the company that they're looking to work for or purchase things from fits with their values, then they are more likely or inclined to purchase something from that company and to do something with it. So in here, it's looking at, then they give you a bit of an idea of how they treat their employees. So this is some of that ESG side of things, that social and environmental impact and all that sort of stuff. So it means if we can get an idea of what some of these trends might look achieving or fixing or helping people to do, then it will give us an idea of what's going on in the entire industry, and we can have a look at how we might be able to put some investing places in that. It's about thinking outside the box. It's a little bit innovative, but it's also one of the ways that we think about things when you do your fundamental analysis, particularly if you're going to be looking with your stocks. So another example of one of these reports here is really looking at the social side of things entirely. So this whole report is just about social trends, what people are looking for out of companies when they go to work for them, and how companies are trying to get people to come in. They want to always, obviously, if you're at the forefront of a particular industry, it might be technology, it might be cars, you want to attract the best talent that you can. And so these are the ways that they are doing that and how they are trying to make that sort of happen, improving that human interaction. So they are quite, dependent or driven by the human condition. Naturally, when you go to the tech trends, it's going to be talking about tech. There are a number of other places that we can consider looking at these sort of things. But if we can build up an idea of what's going on, here we've got they list it for us basically straight out. They're looking at this architecture side and the technical architecture. We're looking at the human experience sort of platforms, digital twins, and I can just read out these sort of headings for you and give you a bit of an idea. But they are sort of the main focus areas that they're looking at. They're looking at macro technology, ethical technology, and what might be happening in finance and IT in the future. So this was just one of them. The Deloitte ones I tend to like. The other ones I like are by a company called Bain. You may have heard of them if you're in marketing. I'll just go up the top so you can see. Oh, no, it doesn't say. That's their logo. If you ever do see that, the company is called Bain. And so these guys do the same sort of thing. They have a look. And there's lots of these different reports you can get. Some are better than others. Just depends where you want to have a look. And it will give you a bit of an update. So these ones here are really all been in the more near term. They've been looking at the idea of what's been going on with COVID-19. The ones that you might look as a global trend or the whole idea, and this is how we sort of have to think about it. And the IPSOS ones, or Ipsos as they call themselves, are probably my favorite of the lot because they do tend to give you a really broad idea of what might be happening. You can get even larger reports than this. Obviously, this is a big one with 104 pages. And they talk about the ideas on how things change. And change is responsible for new businesses, growing businesses, and new projects. So this is why we have to have an interest in this sort of stuff. If we're thinking about what affects the world, and this diagram that they've got on here really does put it well, is that if there are macro forces across the world or certain effects occurring or things that are changing, so right now we're thinking about the COVID-19 side of things and how it's changed the world and how it's put everyone in different places. So it's pushed this idea of into a trend where people need to be working remotely and technology is important and we need to be using Zoom and a variety of other sort of techniques to do things to be able to get our message or our businesses happening and going across in the right capacity. And then from there, it might move into the next section, which is the signals that we need something better. So they start to develop, and then you get the response side of that coming back. And so the whole idea of this sort of idea of thinking about identifying trends and what might be occurring in the future is to give us an idea of where some of those markets might actually be. We're going to be looking for where consumers are going to be spending their money. We're going to be looking for businesses that are going to be having meaningful impacts. And some of the ideas that are happening right now, we can actually think about when it comes to this environmental side of things. Naturally, oil prices have gone down, but there has been a big push by the IMF, by Citigroup, by major institutional banking sort of lenders and things like that that are preventing coal from being produced. So the only country now backing coal development and coal projects in Africa happens to be China. When we look at the idea of what Citigroup and a number of other big institutions that would usually lend money to companies like Shell and BP for being able to go and develop and find and explore for oil, they're now putting on a time limit on that. Over the next 10 years, they're going to basically cut off all financial services, including bank accounts, to companies that deal in fossil fuels. So there's a need of change that's occurred. We can expect that over the next 10 years, it's going to be harder for them to find some banking conglomerates, and we're likely to see more pressure put towards that. The counter side of that is that we're going to start seeing a lot more companies being built and a lot more funding going towards environmentally friendly fuel sources. So right now, I know that one of the ones that I've been looking at quite closely is by Samsung, where Samsung have developed a solid state battery, which is not something that's ever been done before as far as I'm aware. But the idea is that it could be a game-changing push, especially for the idea of an electronic vehicle. So from there, we might consider what we would be looking for. In this instance, I'm talking about this idea of a solid state battery being developed by Samsung. Then we might look at the idea of actually investing in Samsung, because they might actually be the guys who make the difference and put a push towards building out the technology that's required to really expand that side of the economy. Now, another one that I sometimes look at, this one's not too bad. It's a bit of an infographic, and these are really simple to look at. So the Global Web Index, they do this all the time. So they're saying that, in the first one here, what's up, Doc? What they're really saying is that health is going to be one of the biggest ones to be looking for in terms of global trends, because we're going to see a lot of expansion for it. In Australia already, we spend approximately $180 billion a year on our health system, just keeping it running. That doesn't incorporate the idea of what really gets spent by private health insurance or any of the other things. It doesn't really focus on on stuff getting expanded and building out new ways of delivering health services to the patients. So this is an area they're saying is going to grow, because we have got an expanding global economy pretty much all the time, and we've got an average growth rate around the world of about 1.2%, I believe, from off the top of my head, that we're then going to need to have health services grow with the amount of population that we have, so that we have enough of it. And part of the issue that we're having right now when it comes to COVID-19 is that our health services have been set up for, you know, accidents and injury and illness, but nothing on this sort of scale where you can get so many people sick at one time that it sort of floods the health system. So that is the first one to sort of be keeping an eye on. And I think now now that COVID-19 has all happened, there's going to be a much greater demand for health things. So health stocks are good places to sort of have a look, a good place to have a think about it. It could be a startup business that you look into instead, and you might want to privately invest in it. But that's another way of doing things. So the next one to do is privacy in a cashless future. So they're talking about the idea of people not being able to protect their own personal data, specifically metadata, and that there are probably going to be some worrying about where the data goes, and people are going to be worrying about that. So there could potentially be a push in a global trend for tech companies to produce platforms and apps and things like that that'll help prevent people getting your information. Then we get the next one where it's about technology. Now, whilst we have technology boosting all the time and people wanting to do things, this is the idea of actually having a human experience. And it is more important now than ever, when we are also socially, cut off from one another. It is human nature to want to see and speak to another person. We are social beings. So having this sort of presence is probably not a bad one. It's the idea of how do we combat where the whole world has wanted to go to a digital forefront. How can we bring it back to the human side? At least that's what they're saying from this sort of thing. That may not be something to invest in, but it's still something interesting to keep in mind. And we can keep on going through these. Retail being reinvented, a new way to sort of do shopping, especially with the digital front. Then we've got the other ideas of when we might see things sort of actually happening and what internet users are doing. Regardless of all this, the idea of the trends continue and continue, and they go on. You can sign up to them. They will send you an email quite regularly and give you when there's a new update or something like that. I do like them. They're quite good, these guys, because they are just an infographic, real quick and easy, and you can read more. Now, the other ones are little simple things like this, where you can go through, and this is I can't remember this is a McKinsey and Company. So McKinsey is a big marketing and innovation sort of hub. They do a whole lot of different things, and they're very much like Bain. Bain are the exact same sort of company, and they have their own report as well. So I'm hoping that this has all given you all a couple of different ways to think about how you might identify trends and how you might look at potentially looking for investments and what goes on from a culture driving side of things, but also from a technical side of things and how we might think about it if we were going to be more of a technical trader. So I'm hoping that has helped you all out tonight. Now, I know I've been monologuing, which for like 45 minutes now. So if anyone has any questions, feel free to put one in. I'll try and give you guys about 5 minutes worth of question times, and then I'll start wrapping it up. So if you have any questions, put them in now. I'll give you about a minute or two to do it. And otherwise, I'll sort of start looking to close this up and let you all go and have dinner or go to bed or whatever it is that you would like to do for tomorrow. Okay, so everyone seems to be pretty cool with what's going on tonight. So I will start wrapping it up for you. I know time is important, so I will wrap it all up. The places, if you want to get more stuff from me, then there is plenty on the ACY Securities website. You are quite welcome to check out some of the blogs, some of the FinLogics posts, whatever it may be that I do. Obviously, a lot of my videos on YouTube. Uh, you'll also be able to find there what the next webinar is. So next Tuesday, it will be a live market analysis sort of thing. So I encourage you all to bring your own charts, and perhaps if you want a different opinion or you want a different look at things, I am quite happy to mark up the charts as I see them in front of you in case it is something you just want a second opinion, or perhaps you're thinking about a trade. So feel free to do that. If you do have any questions, feel free to shoot me an email at talktoal@acy.com, and I'll be more than happy to respond to you when I get a moment in my day to do so. But otherwise, I will leave you all with it for tonight. I hope you have enjoyed tonight's webinar, and I look forward to seeing you all at the next one. Have a good evening.